Hi YouTube, what's up? This video is about how you can invest successfully in cryptocurrencies. I think the most important thing is really knowledge, because I see people sometimes say, if I had a certain amount of money the problems would be solved, but I don't think that's 100% true, because most businesses fail because they don't know what they are doing. Risk comes from not knowing what you are doing, so you have to minimize the risk by actually knowing what you are doing. And the way that you can do that is by learning fundamental analysis or technical analysis. These are two types of ways that investors or traders base their decisions on. So how it works is, fundamental analysis is basically kind of common sense investing, because you look at things like, does this cryptocurrency has a competitive advantage? Is the management capable of things? Is it fairly valued, or am I paying too much for it? Things like that. You try to look for good investments, and technical fundamental analysis is mostly used by investors to make long-term decisions. And then we have technical analysis, which is basically charting, reading the charts with different tools like elite wave analysis, Fibonacci, RSI, MACD. And it's often used by traders to make short-term decisions, short-term trades, because on long-term financial markets are driven by fundamentals, but short-term it's something very sentimental. Investors tend to overhype things, and when things crash they become fearful. So you have cycles on financial markets, everything goes in cycles, and that's how technical analysis works. You try to predict the sentiment, because often people have the same kind of reaction to things. People react to events in a certain way. I found technical analysis working much better to make trades. I think fundamental analysis is pretty much worthless to make short-term trades decisions, but it can work very well if you're a long-term investor and you want to scout for interesting investments. So the key is knowledge. It's not all about money, because when you look at new companies, tech companies, most will fail. It's the hard truth. You have to have a good idea, a very good execution, an advantage on your competitors, because in a big sector there will always be competition. So why do people have to buy something from you instead of competitor, or choose for your product? What are the advantages? And it's not only like what you buy, but also what price you pay, because value is what you get, the price is what you pay. It's not because something is more expensive that it's better. You have to find a way to calculate the value of something, but with cryptocurrencies this is very hard, because there's like normal valuation like you have on the stock market doesn't work. On the stock market you look at things like PG ratios, the discounted cash flows, PE ratios, and they tell you if an investment is expensive or rather cheap, but you can do this with cryptocurrencies. Question is, how much are they really worth? How much is a blockchain really worth? It's hard to put a price on it, and I think that's one of the reasons why it's so volatile. We have seen that with the dot-com bubble in the early 2000s. Tech companies were very new, and investors didn't know really what to make from it, how much the companies are really worth, how much revenue they could generate. So most of the value is based on future expectations, because if you look at the dot-com bubble, a lot of these companies, almost all, they were not making any revenue, but people thought they would be making a lot of revenue in the future, so that's why they put a high price on it. But it didn't turn out that way. By now, most of the tech companies you had in the early 2000s are either went bankrupt, or another company bought them over, a merger and acquisition. And with cryptocurrencies, it will be the same. Most blockchains will not survive in their current state. I'm not saying they will all fail, but they will do hard forks along the way. New blockchains will come, and old ones will disappear, or they will become almost worthless. Things evolve all the time. That's one of the hard things about investing. You have to keep up. Something that worked 2 weeks ago maybe doesn't work today. Something that worked a year ago doesn't work today. Markets change. People, their desires change. And also, like, markets grow up. Right now, the crypto markets, it's kind of childish, I would say, because you have all these memes and all these scammers, and really most ICOs are shit. But if they want to attract capital from Wall Street, they will have to cut off their ponytails and put on suits instead of a t-shirt. Otherwise, Wall Street won't take them serious. With tech companies, it was the same. It was kind of run by people in the early 20s, 30s, hippies, and it grew up. The sector grows up. You see that with everything. Take for example marijuana. I think it's a year ago or 2 years ago in the United States, marijuana was legalized, and now you have all these companies that pop up, and they become mature after a while, because you have to companies evolve all the time. You have to keep evolving. And with blockchains, it will be the same. I think the most important thing, if you're an investor, is having a competitive advantage, and also try to buy the dips, sell the rallies. You can look at the RSI for that. It's a very good tool. For example, if the RSI is 20, it's extremely overbought. It's extremely oversold. If an RSI is above 80, it's extremely overbought, and it will eventually come down. And also, like, if you have bearish divergence or a bullish divergence, it means that if you have bullish divergence, there's a high chance that an uptrend will happen, vice versa. Because like I said, financial markets are very much dictated by investors' sentiment. One of the key things I think is doing, it may sound strange, but it's like this: you have to do the opposite of what most people are doing. For example, in the end of 2017 there was this extreme bull market, everything went parabolic, and you saw a lot of newbies who went into crypto. They chased the high prices, but it doesn't work like that because we crashed big time. If you would have bought cryptocurrencies back then, you're probably down like 80%, 90%. You have to buy when nobody wants to buy, but it's common sense, because when nobody's want to buy, you can have a good deal. If everyone is buying, things are overvalued. So I like to do the opposite of what most people are doing. And also, like, most people are not good investors. Just for that reason, they chase prices. They only buy when things are already expensive, and then they panic sell when things crash. But you have to realize, financial markets are never right. I think they are always wrong, in a sense that assets are always over or undervalued. They are never at an equilibrium. In the 1980s, institutional investors and some academic people thought that financial markets are efficient, but they are not efficient, because every investor has to make decisions with only limited resources, limited knowledge, limited time. There's not really somebody who has perfect knowledge, and therefore financial assets are never correctly valued, because we, as investors, you try to rationalize things, but it's hard to put a price on assets, because for a big extent it will always be speculative. It's not 100% rational. People do stupid things all the time. Like, take for example the bull and bear market. It was not really rational that certainly we went parabolic in 2017, while a year prior nobody wanted to buy cryptocurrencies. How does that make sense to you? If you ask me, it doesn't really make much sense at all. I don't get why people do it that way. But it's like I said, try to do the opposite, in the sense that you buy the dips, you sell the rally, you sell the breakout. That's how traders make money. But it's more complicated than just buying something when it's cheap or selling when it's expensive, because you also want to buy quality. Because not everything will recover. Some companies will go bankrupt, and you don't want to be the one who's holding the bag, holding the investment. That's why I like to buy quality coins. For example, Monero, Ethereum, Bitcoin. People want to buy small ICOs. They think they can go up more in value, which is right, but over time most will just fail. So you have to be very careful with where you put your money. Try to buy sound investments. If you want to make something more, and you have the time, you can trade it. People say day trading is like dangerous, but I don't think it's more dangerous than investing. I think it's quite the opposite, to be honest, because investors are often the ones that keep holding the investment when it goes down, and holding is not that profitable, at least not when you hold it when it goes down. You don't want to be the back holder. It's all about timing, really. Timing is very, very important. As we have seen the bull and bear market of 2017, 2018 is a perfect example. People who bought end 2017, they are at a loss, but if you bought it a year prior, you made a lot of money. But also, like, it's not a perfect science. What I like to do is average, which means you buy a little bit each time. For example, every time it goes down 10%, 5%, you buy some more, and you buy. The more it goes down, the more you buy. So you average your buys. Vice versa, if it goes up a lot, try to sell some in bits, and that way you can never lose money because you already sold a big portion if it goes up. I know some people who did this. I know a guy, he was one of the early investors in Monero, and what he did is every time it went up like 10%, he sold, I don't know how much, like for example he sold 10%, you know, and at the time that the bull market is at its peak, he already cashed out a lot, and of course you will miss out on biggest gains, but it's a very risk averse way of investing, and it's all how you look at things, because it's first off, it's hard to time the exact top. I think nobody bought on the exact bottom and sold on the exact top. It only happens in textbooks. In real life, things don't go like that. There's always uncertainty. Even if you are very skilled in technical analysis or fundamental analysis, you can still be wrong. Because, for example, if a big investor makes an investment and the price spikes extremely, how can you time that someone will make that certain investment? With cryptocurrencies, you see that often. A few weeks back, no, it was like a week back, this was the case. We now went over $5,000 because of one guy putting in 100 million. That's why averaging is important. I hope you learned something from this. If you want good trading advice, check out Lunar Express on Twitter. Thanks for watching. Bye.